If you have $4 a day, that's about $100 a month, you can retire a millionaire, assuming you have enough time. Take a look. If you invest $100 a month consistently and you do this for 45 years and you just get the return on the markets, which historically the stock market has grown by more than 10% a year, but let's just say you get 10% a year, you are going to retire with over $1 million in your account. Now, you might say, well, Jaspreet, $1 million is not enough for me. But Jaspreet, I don't want to wait 45 years. That's fine. But remember, we're just talking about investing $100 a month. If you want more wealth, either work to invest more money, invest it for more time, or work to get better returns. TRM, time, return, money, those are the three factors that will determine how much wealth you build. And small changes on the back end can add up to a lot more dollars. For example, if you can get a 13% return instead of 10% return, now you're not going to have $1 million or $1.5 million or $2 million or $2.5 million. Now you would have $2.8 million just because you got a slightly better return. That's the power of understanding how to invest your money. So how do you actually go about doing this? Well, the best way to understand what you should do is also to understand what you shouldn't do. What you should not do is go out and try to trade stocks. Being a day trader, being a trader is a losing proposition. Some people will make a lot of money. Most people will lose money. Trading is like gambling. There's a reason why most people lose. And some people can make money when markets are going up, but markets don't always go straight up. We see markets go up and down. Trading is very attractive because people can lure you in with huge gains, but it has been proven to be a losing transaction, especially when you look at it over time. The goal is to build wealth, and if the goal is actually to build wealth for you, you need to be an investor, not a trader. Mistake number 2 is waiting until you have quote unquote enough money to actually start investing. We see that, well, $100 is enough. And this is where mistake number 3 is just blindly throwing your money into whatever is on CNBC or Reddit or whatever your friends are talking about. This is another form of gambling. When you go out and invest your money into the markets, you can be an active investor in the markets or a passive investor in the markets. As a passive investor in the markets, your goal is just to get the return of the market. And we know that historically the stock market has grown by a little bit over 10% a year. So if that's your goal, then, well, there are funds that give you exposure to that. For example, VTI. This gives you exposure to the total stock market. If the stock market goes up, this fund goes up. The stock market goes down, the fund goes down. So when you buy VTI, you're getting exposure to 2,000 plus stocks in the stock market. If you want to get a little bit more niche, SPY. SPY gives you exposure to the S&P 500. That's a group of the 500 largest companies in the stock market. So now you're getting a little bit more niche, but still focus on the 500 largest companies. And if one of those big companies, say Amazon, starts to struggle, they are on the verge of bankruptcy, this fund will kick Amazon out and replace it with somebody else. You don't have to do anything. That's why I call it passive. You want to get a little bit more niche, QQQ. This gives you exposure to the NASDAQ 100. That's a group of the 100 largest companies in the stock market that are not financial. So this is primarily tech. These are market funds that give you exposure to the broad market. You can get more niche to find even more niche sector funds. For example, there are funds that give you exposure to AI stocks. There are funds that give you exposure to healthcare stocks. There are funds that give you exposure to international stocks. There are funds that give you exposure to dividend stocks. So if this is the game that you're going to play, being more of a passive investor, great. You can get the returns of the market, which we've seen to be a little bit over 10% a year for the last 100 years. The way that you win as a passive investor is by doing A, B, B. Always be buying. And that means you set up a cadence every week, every 2 weeks, every month, and money is automatically pulled out of your checking account and invested into whatever funds that you want to invest in. That's passive investing. Active investing is for people that want to be more involved, to take on more risk for more potential return. Now you're going to be looking for individual companies to invest in. This is the Warren Buffett strategy. You want to find a company that you believe is undervalued and you want to own it for the long term. And the way that you succeed here as an active investor is by looking for what I call market shifts. This is what my firm focuses on. We research these types of shifts. We're studying where the economy is moving. We're studying where money is moving and how that can change investment opportunities. More work for more potential return, but also more risk. Because if you invest your money to Amazon, thinking that Amazon's going to take over the world, and then Amazon goes bankrupt, you lose all of your money. But if Amazon does actually take over the world, well, now you can make a lot of money because you own those shares of Amazon. So the way you succeed here as an active investor is to actually spend time doing the research. You actually spend the time reading financial statements. You actually spend the time studying what companies are doing. Now, as a little disclaimer and a little kind of exciting point, One of the things that we're working on at my company, we used to be called Briefs Media, we're transitioning to Briefs Finance, is we are building a very powerful tool that I've never seen before that has data, that has AI to help you do the type of research with a click of a button. It's not done yet. We've been working on this for a while, but it's going to be released, looks like sometime in early 2026. But that's what active investing is all about. It's about researching companies and finding those opportunities that you believe in for the long term, meaning at least a year. That's how you can start to allocate this money. So it's not about investing $100 one time. It's about starting with that $100 and then finding another $100 the next month, and then finding another $100 a month after that. That is a proven strategy to retire a millionaire, even if you're just doing the basics of just throwing your money into the markets. But then if you want to get a little bit more involved and you want to get into active investing, now you can start to get better potential returns, assuming that you're investing in your own research. And now you can have more than what you would have had here. Potentially, more risk as well. But you got to figure out where in your journey you are. Are you going to be working for more income first? Because, well, if you only have $100, yeah, it's probably a good idea to figure out how you can earn some more money first and then take the extra money that you don't need and just start throwing that into your investments. That way your money can start working for you when you're not working and you're working your butt off to earn some more money. That way you can get to the point where now your money is producing enough income. That way you don't have to actually keep working to produce more money. You have enough assets, you have enough investments that can produce that income for you. So if you have the extra $100, what do? Start by laying your foundation. That is, save your first $2,000, pay off the credit card debt. Then, if you want to create more income, that way you have more money to invest. We talked about taking that money, using it to get access to some of the more powerful AI tools. That way you can work to increase your income. Once you increase your income, now you got to be smart with your money. Take the extra money that you're not spending and throw it into your investments. We talked about growing your money by investing your money. You can do that by being an active investor or a passive investor. And we know that if you invest $100 a month over the course of your career, you can retire a millionaire. But if you want more than that, or you want to get there sooner, you have to understand TRM, time return money. The more time your money has to compound and grow, the wealthier you're going to become. Return, the faster your money grows, the wealthier you're going to become. And money, the more money you can invest, the wealthier you're going to become. When you understand that, now you start fueling the process, and you don't need a ton of money to start, but you do got to start. If you want some more resources on how to invest, again, you can check out my investing masterclass that I have for you down in the description. And if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, a family member, a colleague, or a fellow investor. Thank you. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.